Hello, everybody. Thank you for joining me for today's webinar. Today, we're going to be talking about how the IRS analyzes financials for determining your client's ability to pay. Before we begin, though, on the content, I'd like to tell you a little bit about myself. My name is Vinar AR. I am a tax attorney in Michigan, founder of AR Law. In my practice, I help individuals and businesses who are delinquent with their tax filings or otherwise have a problem with the IRS. Main thing you should remember about me is you can use me at any time as a free resource in your practice to help better serve your clients. And what I mean by that is if you ever have a client who runs into any kind of IRS situation at all, you can feel free to call me anytime and ask me questions. Examples of questions you might ask me: what to do if a client can't pay their taxes, what to do if you don't think the client should owe, or if you think that, penalties should be waived, or if a client's being investigated, by the IRS criminally or civilly or, anything like that. Pick up the phone anytime. I even have a separate number set up just for accountants and other professionals who want to call me with questions. So take down my number, give me a call anytime you should run into any kind of tax situation. So without further ado, we will begin on today's webinar. So the topic of this webinar is going to be how the IRS analyzes the taxpayer's finances to determine their ability to pay. What we're going to be talking about is first a broad overview of the financial analysis process, what it's for, why it's used, what we're trying to determine, and then we're going to go and do a deeper dive into how the IRS looks at assets and income, and then talk about expenses, and then we'll talk about what kind of efforts you can expect the government to make to verify financial information that they're given. So, financial analysis in general, what are we talking about? What is a financial analysis? We're talking about the IRS process for securing, verifying, and analyzing taxpayer financial information. We're talking about current financial information, their current ability to pay, because that provides a basis for determining the reasonable collection potential and the taxpayer's monthly ability to pay, which are relevant in different circumstances. Monthly ability to pay is useful in determining installment agreements. Reasonable collection potential is useful in determining IRS offer and compromise eligibility and the amounts. It also gives collections employees the basis to make appropriate collection decisions in order to resolve their cases. So there's many options and programs available for taxpayers who are unable to full pay what they owe. I mentioned briefly IRS installment agreements and also offer and compromise. There's also a currently non-collectible status. The purpose of the financial analysis is to determine ability to pay, which impacts the taxpayer's eligibility for these programs. Financial analysis is also a factor in many other determinations the IRS makes. For example, innocent spouse determinations or trust fund recovery penalty assessments. For those kinds of determinations, they do consider financial analysis in making their decision or financial ability to pay. Now, how are financials analyzed? There are basically three categories that they look at. They look at assets, they look at income, and then they look at the expenses. Okay, those values are used to determine two things. First is the taxpayer's equity in assets, which of course is the amount of money the taxpayer has access to right now if they were to liquidate their assets. And we also look at their disposable monthly income based on the financial analysis. So notice that one thing we did not talk about when we're talking about categories of information is they're not looking at liabilities. They're only looking at assets. If you owe a debt, it's not considered unless it is used to secure, unless it is secured by one of the assets. You can use it to offset the value of the asset. For example, if you have a mortgage on the house, you consider that in determining the value of the house. Of course, you can't get equity without paying the mortgage. But if you have credit card debts or some other unsecured debt, it's not considered when the IRS is looking at the finances. Now, I mentioned a number called the reasonable collection potential. It is a figure used in determining eligibility for an IRS offer and compromise. what it is it represents the total amount that the IRS can expect to collect over the life of the debt. Okay, the total amount the IRS will collect over the life of the debt. It's comprised of three different components. First, the net realizable equity, then your monthly ability to pay, multiplied by the months remaining on the collection statute expiration dates, CSED for short. That equals the reasonable collection potential. Now I noticed I mentioned the CSEDs, the collection statute expiration date. Just note that generally speaking, the IRS has 10 years to collect a debt. So what they're trying to do in determining reasonable collection potential is they're trying to determine how much they're likely to be able to collect before the debt expires. Again, that's used as an eligibility criteria for offers in compromise. And it's a very important number that they look into when they determine if you qualify for a settlement based on an inability to pay. Now, how do they actually look at your financial information? What are they looking at? What they'll ask you for is you have to fill out something called a collection information statement, which is a form that provides a complete and accurate picture of the taxpayer's current financial situation. The information should be no older than the prior 6 months. If it becomes older than 12 months during the course of the case, then the IRS is required to update the information and get new stuff. Okay, so what is a collection information form? There are different forms we're talking about for an individual. There is a 433A form, which is a long form collection information statement. Is used whenever you're dealing with a field collections, aka a revenue officer. Okay, so if you have a local agent in the field assigned to your case, they are going to require that you fill out a 433A. Also worth noting that you have to send in full substantiation with the 433A. What that means is every number on the form should have some kind of document to back it up, and the form should be backed up with a stack of documents to support all of the figures that you used. There's also for individuals a form called the 433F, which is a short form collection information statement. It's used when dealing with the automated collection systems. Whenever you have a client who owes money who has not been assigned to a local agent, they will ask you for a form 433F whenever they ask for financials. That is a short 2-page form as opposed to a 6-page form of 433A, or actually 8 pages. And with a 433F, you don't need to send in any substantiation unless requested. Usually, if you have a client who owes, say, $150,000 and they're dealing with IRS collections, you don't even have to send them any documentation to establish a payment plan or to establish that the client's uncollectible. You simply have to pick up the phone and go over the numbers. You don't even have to send the form in, to be honest with you. You just pick up the phone, you call the IRS collections, and you can go over verbally the numbers on a 433F, and you don't actually have to send it in, and using that to determine whether a taxpayer is uncollectible. And most of the times, they won't even ask you for any documentation. You would be surprised at how easy this can be. The other form that individuals might use is a 433A OIC form. This is very similar to a standard 433A form. However, it's only used for offer and compromise applications. The difference between this and a standard 433A is a 433A OIC incorporates certain rules that apply only to offers, which we'll talk about later, and also makes it easy to add up, and it includes instructions on how to add up and calculate the minimum offer amount for your offer. And then if you have a business taxpayer, you would be using a 433B or a 433B OIC. Notice that for business taxpayers, there is no short form. There's only a long form collection, which is a 433B form. Now, on your screen, you should see a difference. On one side, a 433A, the other side, a 433A OIC. You'll notice that the forms are just laid out a little bit differently on the front page. There's questions on the one that aren't on the other. Those same questions occur later on the form. They're laid out differently, and then, as you get into it, you'll see that there's certain boxes that are bolded and certain instructions that don't occur on the other version. Same with the 433B and a 433B OIC. You can see in the upper left-hand corner where it shows which version of the form you're dealing with. So now compare that to a 433F. What we were looking at with the 433As and the 433Bs was just the first page of the form. This is the entire F. It's a 2-page form where you list out, there's different sections, assets, income, expenses. You list out your taxpayers' expenses, and this is the information that the IRS Collections Office would ask you for over the phone if you're trying to negotiate an installment agreement or if you're trying to negotiate non-collectible status for one of your clients. Now, when you're talking about the business financial forms of 433B, it is important to note that this is not referring to a Schedule C business or a single member LLC taxed as a disregarded entity. If you have a taxpayer who's self-employed and files as a Schedule C, their business information is actually incorporated at the end of the 433A. They don't have to fill out a separate financial form for their business if that is the case. The business forms are for businesses who owe taxes. Usually partnerships or S-corps who haven't paid their payroll tax. Could be for C-corps who owe income tax, or it could be for any tax or any penalty. It's when a business has a balance, or when there's an individual who has a balance who owns a business and we need to value the business. The IRS will use a 433B form. They always want you to include a balance sheet and a year-to-date profit and loss statement. That, to be honest with you, a 433B is a very simple form. A lot of the information is really on the balance sheet and the profit and loss, which you can attach. So it's important that there's a good accountant on board, or that you're doing the accounting, and that you have the client up to date, with the profit and loss and balance sheet. The information should match information provided on other financial statements, tax returns, and schedules. This should be a no-brainer. When you fill out a financial information form, make sure that your financials are consistent with other stuff the taxpayer might have provided to other people or to the IRS. Because the IRS, as we'll talk about later, does verify information. So with that, takes us to our first polling question of the day. So now we're going to talk about how the IRS looks at assets and how those are analyzed when determining financial situations. So now, for individuals, what are we talking about when we talk about assets? Of course, anything that has value is an asset, any property with value. The types of things that you need to disclose on the financial information forms: bank accounts. If it's a joint debt, you need to add the accounts for both spouses. You want all the investment accounts. Real estate, it's a primary residence, whether you rent or own, you have to include it, because even if you rent property that is a leasehold, you have to value your property. If you own rental properties, investment houses, any kind of investment property, you need to list it. Vehicles, recreational sport vehicles, your everyday work car, personal effects. Cryptocurrency is a new section on the form that they just added as of the 2020 revisions. Pretty much anything you can think of, you go down the form, there's a section for bank statements, there's a section for vehicles, there's a section for other investments, there's a section for other assets not otherwise listed. Any property that the taxpayer has an interest in, which has a value, needs to go on the collection information statement. You can estimate values. Of course, value is a very subjective question. There are many ways to come up with a value. Sometimes you can estimate things. You can use any reasonable method when you're determining the value of the asset. Of course, if you have a bank account or something, the value is determined. You just list the balance in the account. But if you have real estate, there's a lot of different people that you might ask. Everybody will come up with a different value for a particular piece of real estate. You can use whatever is reasonable under the circumstances. You can use the county values that they use for property taxes. You can use the Zillow value. You can get an appraisal. You can ask a broker for what's called a broker's price opinion. There's all kinds of ways to value assets. For vehicles, I usually use Kelley Blue Book. I usually use the lowest value, the trade-in amount with fair condition. You go in and you go into Kelley Blue Book. You ask the taxpayer what kind of car they have, year, make, model. You figure out what the additions or the options. I just always assume it's the most basic model, and I come up with what I can support as a reasonable asset value. Of course, generally speaking, you always want the asset values to be low on the forms, and you always want to look for the best source and the most favorable. As long as you can, come up with a number and you have some reasonable basis, put it on the form. You don't have to, disclose that there are other numbers or other valuation methods. Let the IRS do their job. As long as, you're cooperating with your ethical duties and you're doing things honestly and with a straight face, then go out and look for favorable values for your assets. There's nothing wrong with that. Now, when we're talking about business assets, it's the same idea. You look at any item of value owned by a business. There are a number of different ways to value business assets, more so than with personal assets, because you have something called a discounted cash flow analysis. The IRS can look at the value of an asset based on how much money it generates, or based on comparable pricing or what it costs to replace. So same types of things. You're looking at cash, you're looking at intangible assets, patents, trademarks, franchises, loans to shareholders. This is a big one that I've seen a lot of offers and a lot of things get hung up on, where the accountant over the years, somebody will own a small business, they'll take out money year over year, and it'll get thrown on the balance sheet as a shareholder loan. Well, now you're creating an asset for the business, and you got to deal with that. Now, when it comes to valuing loans to shareholders, and also when it comes to valuing accounts receivable and notes receivable, they have to look at the collectability of the debtor and take that into consideration. The value of an accounts receivable or the value of a shareholder loan isn't necessarily the face amount of what's due. You have to look at what the true value of that note is or that receivable, and to do that, you have to consider whether or not the person who owes the money is collectible. They're looking at real estate loans and mortgages that you might hold as a business, furniture, fixtures, retirement plans, life insurance, securities. Those are more on the personal side, the retirement plans and the life insurance, but businesses can have that too. A lot of businesses will take out key man life insurance policies where they carry insurance on some of their more important people, and those can be assets if they have a value. Now, there's a special rule when it comes to income producing assets. This applies both to individuals and businesses alike, is if there are assets that produce income, you have to consider the loss of income that the asset that would be incurred if the asset were liquidated or used as collateral in a loan. So you get to adjust the income numbers, which we'll talk about briefly in a little bit, based on the anticipated loss of income from the disposal of the asset. Or if you plan to use the asset as collateral, you get to adjust the expenses to account for the loan payment that you will have once you borrow against your house or you sell that piece of property. Any income producing asset or any asset really that's going to be used as collateral for a loan to pay the IRS, you have to make sure you account for the loan in the expense analysis. Now, when you're dealing with marital assets, sometimes this gets tricky because if only one spouse is liable to the IRS, you do not have to disclose assets belonging to the non-liable spouse. They do not have to sign the form. The only person who's required to submit financials is going to be the taxpayer who owes money to the IRS. The spouse is not a signatory and they do not have to list their assets. However, if you have a jointly titled asset, the default rule is they split the interest 50-50 unless you can show who put in more money and you can come up with some other method to allocate the asset among the parties. Any jointly held asset will be 50-50. The reason I say this is a complicated issue is because it is not always clear which spouse separately titled assets belong to. You have to look at more than just who holds the title. Property ownership is a question of state law, so the answer depends on which state the taxpayer lives in, which state they were married in, because you got to look at community property laws, you have to look at equitable ownership doctrines, and so on and so forth. So it's not always clear, but what is clear is whatever assets belong to the non-liable spouse do not need to be included on the form, but the question of which assets belong to which spouse is a question for state law and beyond the scope of what we're talking about here today. Now, when it comes to assets, like I mentioned earlier, when you're doing a 433A or a 433B, there are special versions for OICs, and those special versions are made to accommodate special rules that only apply to financial analysis, asset analysis in the offer and compromise context. The first is there's a $1,000 cash allowance. Whatever you have in the bank account, you get to subtract $1,000 from when you arrive at the net value. Plus, there's a secret allowance of 1 month's worth of bills. In the IRM, the site is in the slide, but in the IRM, it says that if there's money in the bank, first you get to take $1,000 off the top, and then whatever's remaining, if you have reason to believe it needs to be used for the monthly bills, you get to subtract 1 month's worth of household expenses from that amount and arriving at the value of the bank account. So you're not just going off the number on the bank statement. There's also an allowance of $3,450 per vehicle. Okay, now this isn't taken into consideration when they're determining the reasonable collection potential. It's only taken into consideration when determining the minimum offer amount, but that's kind of a technical difference. The other big thing is when it comes to valuing real estate, there's an 80% quick sale value. So when you're valuing an asset, real estate, or another illiquid asset, you can get an appraiser to tell you what the fair market value is, and then you get to take 80% of that to arrive at the quick sale value, and then you get to subtract the loan balance, and that resulting number is the equity. So there's a lot of opportunity to kind of take advantage of this. A lot of times I'll have taxpayers who are not homeowners, who might have some money in savings, either in a retirement account or saved up in the savings account in the bank. And one of the first things I'll tell them to consider doing is to use that money to put 20% down on a house. Because when we're valuing assets for offer purposes, I have to include the value of the money in your savings, less whatever allowances. But if you were to take that same money and use it to buy a piece of real estate or to put 20% down on a piece of real estate, you more or less kind of make it disappear, So there's a lot of gamesmanship and a lot of setting up to be doing when you're doing an offer and compromise. The other thing to consider is when you're talking about retirement accounts, you want to account for the tax effect if they were to liquidate the accounts. So you're always looking at after-tax balance. The other big rule with offer and compromise is you generally, when it comes to any income-producing asset, you get to just value it at zero. All the stuff I talked about a few minutes ago about adjusting the income and the expenses does not apply to income-producing assets for offers and compromise because you just get to exclude the value of the asset from the computation. However, one big exception is this does not apply to real estate. Another thing that comes up during offers and compromise is this comes up against the taxpayer. Sometimes they'll give you an asset. They'll say that there is a value of the business as a quote-unquote going concern, and they'll throw what I sometimes consider a phantom asset on the analysis and say that the business has a value. But there's a lot of rules to that, and there's a lot of nuance that you have to, if this ever comes up, I never include business as a going concern as an asset on my forms, it's always something the IRS brings up later if it ever comes up. There are certain arguments you can make around it. You really need to study the Internal Revenue Manual if you come across this situation, um, and know that there are arguments against the business of a going concern. One of them is if the business has no value without the guy working. If you have a self-employed lawyer, well, that's not a business. It doesn't have any value without the individual who owns it working there, so it would be inappropriate for them to value that. So now talking about income, generally speaking, when they determine individual income, they're going to include all household income, including tax-exempt income. This is a different analysis than when you're doing the tax return. Now, when you talk about household income, that doesn't usually include a child, a dependent child, unless it's an adult who contributes to the household. Now, if they're paid weekly or bi-weekly, there are certain multiples, 4.3 or 2.17. All the numbers are expressed as monthly numbers, so you have to convert weekly or bi-weekly payment streams into monthly by using the appropriate multiples. This is what the income section looks like on a 433A form. Notice that there are a whole bunch of different categories of income, but all income, any money that comes in that's regular, that the taxpayer has a right to receive, needs to be included on the form. You don't include gift income, but you do include like alimony. If there is a legal right to receive the money, then that has to go on the form. Sometimes you have to average income. If a taxpayer's income is sporadic, you'll use averaging techniques. What you're looking for is a reasonable picture of what their monthly position looks like. Now, this is what the same section of the form looks like on a 433B. You just list out the different categories of business income. So that brings us to our next polling question. Okay, so moving on. Next, we're going to talk about what expenses are allowed when doing a financial analysis and what the IRS looks at in determining your taxpayer's ability to pay. Now, this is what the expense section of the 433A looks like. You notice that there is a list of all the different categories of expenses that are allowed. There is a spot for other expenses, but generally speaking, only stuff on the list is allowed. There is a test for determining what expenses you're allowed to take and what you're not allowed to take, and that is the allowable or the necessary expense test. What that means is you're only allowed to take expenses that are necessary to provide for the taxpayers and his or her family's health and welfare and or the production of income. So you look at allowable living expenses, other necessary expenses, and other conditional expenses. These are the three general categories of expenses. Only stuff that is necessary to provide for health and welfare. So things like school tuition don't count. You don't have to put your kids through private school. You don't have to pay for their college. That's not necessary for health and welfare. Things like credit card payments, unsecured debts, those aren't allowed. Only stuff that is necessary for health and welfare. The reason credit card payments aren't allowed is because the IRS is a secured creditor, means that they have a lien over the taxpayer. They're entitled to be paid first over any unsecured creditor. So unsecured debts are not included. Now, when you're doing expenses, there are something called collection financial standards. You don't get to just take any expense just because the taxpayer incurs a certain housing expense, for example, does not mean that that is quote unquote necessary for health and welfare. Okay, there are national standards and there are local standards. And what the standards are is that they are a guideline to provide consistence in certain expense allowance, designed to account basic living expenses. They don't apply to corporations, partnerships, LLCs, or business expenses. These are what we're talking about, standards that are in place for establishing basic living expenses, which of course only individuals have. These are the categories of expenses that are affected by collection standards. There's first and foremost food, clothing, and miscellaneous. This standard establishes a minimum allowance based on household size. There is a national standard um, that applies, and you look at the table based on an individual's household size, and that tells you how much you're allowed in food, clothing, miscellaneous without any proof. This is a minimum amount. If you can prove more, you're allowed to take more. But again, it has to meet the necessary test. The only time I've ever asked for deviations on food, clothing, miscellaneous is if I have a taxpayer that has allergies or some kind of medical dietary restrictions, which requires them to spend more money on their food. Then I can argue for more than the standard amount as long as I can substantiate that the expense is actually incurred and that it is necessary for health and welfare. Okay, there's also a standard for housing and utilities. This standard is different though, because this one is actually a maximum amount based on county and household size. You have to provide substantiation for the amount you actually incur. It's not an allowance just given to everybody. It is just a maximum. If you don't have a housing expense, you don't get a housing allowance in your expenses. But if you do have a housing expense and it's more than what they consider reasonable, what's allowed for under the standards, then they will reduce it when doing your financial analysis. They will only consider the amount that's allowed under the standards. There's also a standard for vehicle ownership costs, which is also a maximum. It's based on a national standard. It's an amount that applies across the country compared to housing and utilities, which is a county-based standard. There's also vehicle operating costs. These are minimums. These are allowed without any proof, and they're based on the major metropolitan market that you're in. The last expense that's affected by a standard is the out-of-pocket healthcare expense. Like the food, clothing, miscellaneous, this also is a minimum. You don't have to send in any proof. Everybody gets an allowance for their out-of-pocket healthcare, and this is based on their age and household size. And it is a minimum. If you have a taxpayer that incurs more than what is allowed for in the standard, well, then they get to claim the standard. Now, in my office, we use a cheat sheet like the one on your screen to show the standard. And as you can see, I have different sections and different tables that contain the standards that apply in our market for food, clothing, miscellaneous, housing and utilities. All the different categories we talked about are on my little cheat sheet. The information is not available in this form, of course, from the IRS, but on the IRS website, all the standards are there. Some of them, like I mentioned, are based on counties, so you'd have to find your county. This is just a cheat sheet that we use in my office, where we took all the information from the IRS website and put it all into a Word document, and we have copies. Everybody has copies in the office. And these are updated from time to time, and you have to keep your information up to date because the standards change all the time. Now, when you come across shared expenses and you're determining a taxpayer's ability to pay, the taxpayer is only allowed expenses that they are required to pay. Now, by taxpayer, we're talking about everybody whose income is on the 433A in the income section. Remember when we talked about income, we said generally we use household income, but sometimes when you have separate debts and you have non-liable people, you don't use household income, you only use the liable person's income. So when it comes to shared expenses, and the expenses are shared with somebody whose income is not included on the form, and the bills are paid from commingled funds, which means there's like a joint checking account or they combine their money otherwise and use it to pay the bills. What you have to do is you have to allocate the expenses among the parties. So the taxpayer only gets their pro rata share of the expenses. And their pro rata share is based on their pro rata share of the household income. So you would total all of the income for both of the people or all of the people who are sharing the expenses, and you would figure out what percentage is your taxpayer's income versus the other person's income, and that's your share of the your percentage of the expenses. When you think about it, it makes sense because what we're talking about here is taxpayers who commingle their income. So when the money is mixed and paid from a common pot, only a certain percentage of that money belongs to you or your taxpayer. So you have to allocate the expenses accordingly. Now, again, notice on the form there was a section for other expenses. Now, these are some of the ones that might be allowed. Now, there's also another special rule specific to offered and compromise when it comes to other expenses. There is an additional $200 vehicle operating expenses. That's $200 per month over and above what your local standard is for vehicle operating expenses if the vehicle is at least 8 model years old or has more than 100,000 miles. You get an extra $200 a month over and above the standard operating expenses. Again, this only applies for IRS offer and compromise purposes. I don't know why they don't use the same, allowance for installment agreements, because the same rationale exists is that when you have an older car, you have to spend more money to keep it up on repairs and maintenance, etc. Now, when it comes to business expenses, the allowable expenses are the costs in carrying on a business or trade. Now, note that this is not the same as deductible expenses, stuff thought of on your tax return as a deduction. We're talking about all the costs or all the cash outlays in carrying on a trade or business. So some stuff that accountants might not think of expenses are included. For example, principal payments on a loan or distributions paid in closely held businesses to the extent that the distribution is required for the taxpayer's living expenses. All cash expenses for businesses and individuals require substantiation and verification. So these are the different categories on the 433B form for business expenses. I'm not going to go down the list, but you see them on your screen here. And that's how business expenses are determined. So moving on, the last section of our presentation is going to be about how the IRS verifies financial information that they are provided on a collection information statement form. So there are a number of different ways that they use. First and foremost is through taxpayer provided documents. Remember when I said that when you do a 433A or 433A OIC or a 433B, that all of your numbers have to be quote unquote substantiated. You should attach to your form all the documentation necessary for the IRS to confirm your numbers. The key when I do 433 forms, when I do offers or installment agreements, the key in my mind to success is that you have to make it very easy to follow. All of your substantiation, all the provided documentation should appear attached to the form and be in the same order that the numbers appear on the form itself. So, the first number on the 433A form generally is your bank balance. So the first substantiation document should have a bank statement. And it should be really easy to read. You should circle the number you use to show the IRS how you got to the number. If you did any math, for example, took any allowances or made any subtractions, you should show your work on a cover sheet. Or if you're adding up a bunch of different categories, like with housing and utilities expenses, there should be a cover sheet followed by all the bills that go into the total. The key is for the IRS not to look anywhere else and not to give them any extra work to do. The entire verification on my 433s, I would like to be done through taxpayer provided documents. That is always the first place they look. If they are not able to get all the information simply from the documentations you provided, then they will contact the taxpayer or the representative with any follow-up questions, or they'll ask for additional documentation. If then they're not satisfied that they have a full picture, they'll look at internet sources and online researches. They use a tool called Accurate, which is an asset tool, skip tracer. It shows all the public records, all the court filings, all the professional licenses, real estate taxpayers hold. Sometimes they'll just do a simple Google search. With manager approval, they can, ask for your credit report. They can also issue summonses to verify or collect information, either to the taxpayer or to a financial institution or any other third party. They use third party contacts. They look at loan applications, divorce decrees, insurance policies. They can and will make field calls to come take a look around and see what you have. There's all kinds of ways for them to verify financial information. But if you're doing your job and you're doing it thoroughly, it should all be verified through taxpayer provided documents on the initial submission. Now, of course, that is the dream. We don't always get there. More often than not, they will contact you for follow up questions. They will ask for documentation to substantiate the expenses. But the goal is for them not to have to do that and to give them all of the verification they need through your documents. And with that, we'll go to our third and final polling question. So thank you all for joining me today's webinar. Hopefully you found it informative and you came away with a much better understanding of how the IRS analyzes financial situations. One thing I want to leave you with is I want to remind you all that if you have any questions either about today's content or about anything else related to tax resolution, feel free to call my office anytime or you can shoot me an email. I'm always happy to help, always free of charge for my fellow tax and law professionals. Thank you.